Hello, clients and friends of AAFCPAs. Thank you for joining us today for our Business Transactions for Growth and Exit webinar, specific for the cannabis business space. I'm going to turn it over to Dave, and I'm also going to launch our first poll question.
Thank you, Joanne, and welcome everyone to our webinar on business transactions for growth and exit. And we thank you for taking time out of your busy schedules to be with us today. I am Dave McManus, and I am AAFCPAs Cannabis Practice Leader and a tax partner here at AAF. And I'd like to introduce two of my partners who will be presenting this webinar along with me today.
Hi, I'm Janice O'Reilly. I'm a partner in the cannabis practice focusing on advisory.
Hi, I'm Josh England. I'm an attorney also working in our cannabis group, and I focus on business structure, startup, and exit.
Thanks, Janice and Josh. Before we get into the presentation, I just want to give a little bit of background about AAFCPA's cannabis practice. And we've been practicing in the industry since 2012, and we currently work with over 100 cannabis operators throughout the United States. And most of these clients have been with us since startup, and we've helped them navigate growth in this challenging industry. And many of our clients have also been through a successful exit. And that's really what the content we want to talk today about: growth and exit within this industry and the challenges that we see and how you can successfully manage growth and be successful in any potential exit that you might have. Our focus as business advisors along the way, was to get to know the plans and the goals of our clients in terms of growth and exit, anticipate the challenges that they'll face, and work with them to establish good books and records, maximizing allowable deductions under the wonderful Code Section 280E, and position themselves for growth and potential exit. So that's really the focus of our AAFCPA's cannabis practice. And we take a holistic, multidisciplinary approach to the services that we provide. In addition to the traditional tax, accounting, and assurance services, we also have business and IT consulting that we provide to our clients to allow for a full array of services and be that one-stop shop for all of our clients.
Outside of the traditional tax, compliance, business and IT consulting, and our audit functions, we have advisory and outsourced accounting. So that can be anything from financial planning and analysis, including cash flows and budgeting, to data analytics, to one of the other departments that I work with is transaction advisory. So we can do also just your day-to-day outsourced accounting, but we have a lot of advisors on staff as well.
Thanks, Janice. Next slide, please. So an overview of what we do want to cover today. First is early considerations that will drive future decisions. And what we mean by that is, what to do early in order to put yourself in a successful position to be able to grow, and also to be able to put yourself in a position to successfully develop a strategy to exit the industry when and if that time comes. If you can go back to the next slide, former slide, Josh, sorry. So some of the things that we'll talk about is really covering entity structure, and you want to get that entity structure down early to be able to determine, that really is one of the items that we do like to talk about that will drive the successful exit and growth of your company. Fundraising, debt versus equity considerations, and making sure that, your investors understand really what they're getting into in terms of when they do invest into your company. Strong books and records, those are early considerations. what type of entity structure you have, how many entities you have, how they all relate to each other, and how that all ultimately gets reported on your books and records. So one thing we spend a lot of time with our clients on is just making sure that we have the structure in place to be able to give you the ability to report and, be able to report and also get you the financial information that you need to have in order to successfully navigate this industry, sustain growth, and also to put yourself in a good position when and if the time comes to exit the industry. We'll talk about some of the common transactions that we see within the industry. And with that, the exit strategy that you develop, the entity structure will determine potentially what that exit strategy will be. Typically, what we see in this industry in terms of exit strategy and deals is really an asset sale or a stock sale. And Josh will get into the nuances of those and what makes the most sense in terms of maximizing cash flow in the proceeds from the sale and minimizing taxes. Next slide. So we all know that selling legal cannabis is difficult. With the regulatory requirements, be it state, municipal, or federal levels, there are a lot of compliance requirements that you need to think of as you continue to grow in this industry. And they do become very, challenging to you, and they can be costly, and, they could affect the cash flow of your company. Overtaxation. So this industry is overtaxed. At the state level, you have sales and excise tax that you have to deal with. But we all know that at the federal level, 280E is a big consideration and has a significant impact on our cannabis clients and their ability to be able to grow, sustain growth, maintain cash flow, and to be able to just position themselves in the best manner that they possibly can position themselves. They're currently no movement at the national level. We'll talk a little bit about the Safe Banking Act, the Climb Act, and basically 280E in general. There has been, I think everyone knows that there's been discussion about rescheduling the 280, the cannabis to a Schedule 3 criteria. And we'll talk a little bit how that impact might have on your businesses. One last thing that I wanted to just talk about is at the state level, there are inconsistencies. So if you're looking to get into different states, you need to really know the regulations by states because they aren't all the same. And that is a challenge for our clients that are looking to grow and to expand into new states, really considering what are the regulations and making sure that your books and records are positioned and set up in a way that you can easily transition into these other states and make that as cost effective and as tax efficient as possible. Lastly, the black market is alive and well. MJ Biz, I don't know if folks have seen it, but they recently put out an article about the black market. And for 2023, they're projecting the black market to be $60 billion in sales in the United States. And that's a little bit over half of what the legal market is projected to be in 2023. So, without regulation at the federal level, and with all of these state requirements and, compliance requirements that you have, the black market is going to continue to thrive until something is done. Next slide, please. So what people are saying, a couple of different comments in here about a California grower. Product it doesn't matter how good your product is. There's so much supply out there that it's a race to the bottom. And another comment is, I feel like I'm a lettuce farmer right now. I'm working on the smallest of margins. And unfortunately, in my perspective, we're seeing it here in Massachusetts. The market is getting very, very saturated. There's a lot of competition that's driving prices down, and it's really shrinking the profit margins and affecting the ability of our clients to be able to sustain operations. Never mind, looking to grow and expand into other states. The market saturation is really starting to have a significant impact on our clients. So one thing that we do talk to all of our clients about really at the startup phase is, what to expect, how to manage the saturation that could happen in your, with your business, and to be able to just make sure that the cash flow is managed to a point where you can, sustain operations and look to grow and be able to have the cash flow in the company as you're looking to do those initiatives. Next slide, Josh. So unfortunately, Congress has done nothing. The Safe Banking Act, it's currently sitting on the Senate floor. It's been through the House 7 times for a vote and, finally got to the Senate, but who knows where that's going to go. We don't see anything happening over the next year. The Climate Act that was introduced in 2012, haven't literally heard anything since, so there's really not a lot of action in there going on at the congressional level. 280E is another subject we can talk on. There has been, obviously discussions about rescheduling 280E to a Schedule 3 criteria. But what does that really mean for our clients, and when is it going to happen? It would be great to see some legislation be enacted in 2024. Let's hope that the DEA does, stick with their recommendations, and that 2024 does give us a whole new fresh look on legislation and regulation here in the cannabis industry. So with that, I think we're going to post our first or second polling question. So how are you preparing for change, the future of 280E and cannabis rescheduling? And while folks answer that question, one of the items that, I wanted to bring up, I think everyone's aware that there's been a lawsuit filed in the Commonwealth of Massachusetts against the U.S. Attorney General. And the crux of that lawsuit is really 3 operators in the state of Massachusetts is saying that, Congress doesn't really have the ability to step in and regulate cannabis under the Controlled Substances Act for intrastate transactions. So, all of our clients that operate here in Massachusetts do not cross state lines with their product. And, so the crux of the lawsuit is saying that that Congress doesn't have any ability to enact law over interstate transactions and interstate businesses. So we'll see where that lawsuit goes. I think others might have heard that TruLeave, which is one of the big MSOs, they're looking to not pay tax with a 280E strategy. And we've had a lot of our clients reach out to us and ask us, what does that really mean? And, what makes the most sense for us to do when we're looking to pay our taxes for the remainder of 2023 and during 2024. So I think, we'd love to have that conversation with you. 280E as it stands right now hasn't gone anywhere. But hopefully in 2024, there has been a change with the rescheduling. And, hopefully this lawsuit has some teeth. Josh can weigh in a little bit more on his thoughts on it. He did, on our last webinar, talk about what rescheduling means. So hopefully things will change next year, but I think we need to look at this with an air of caution and to make sure that we're, just really, really considering all potential risk of doing that. And we'd be happy to, to talk to you on an individual basis. With that, I am going to turn the next part of this session over to Janice.
Thanks, Dave. We're going to start out talking anyway about growth and how that will then lead to a successful exit, we hope. As Dave mentioned, we have well over 100, maybe 150 or so clients nationwide, and we've been very lucky to have been with them from startup through exit, and we've seen what's really contributed to some successful exits. And so I'm going to start talking about 4 areas of growth: investment, operations, sale leaseback transactions, and then intellectual property, or what we call IP. So the first one is on investment. I think anybody in the space right now knows that there's been a decline in equity investing. A lot of the convertible notes are coming with, it's either straight debt or they're convertible, high interest rates. So there's a real challenge in the marketplace to be able to get the cash that's needed to support your growth. And whether it's through debt or equity, both are very challenging right now. We have seen, particularly, I think you've all seen in Massachusetts, where there's some funding through the social equity, non-dilutive financing through the social equity pool, and there is some availability out there, but it's been really, really challenging. And the last bullet that we mentioned here is about investors wanting to know what they're getting into. So I'm going to talk a little bit more about that on the next slide. We really encourage people to look hard at their cash flow and their cash flow projections. It's important, if you're planning on exiting or even just having a viable business, that you fully understand what the cash needs of this business are and that you're figuring out how to raise the money. One of the areas that we've seen clients particularly challenged with is figuring out how much it's going to cost for a build out. Particularly in areas where there are multiple dispensaries, for example, and how much do you spend on differentiating your space and attracting customers into your space, and really understanding how much that build out is going to cost. So that's something that we really want you to take a hard look at. One of the areas where we've been able to help clients save money is looking at some of the utilities, equipment. Are there rebates available? Making sure that if there's any ability to not pay sales tax on a particular item of equipment in a particular state, that you're doing that. What's exempt, what isn't. Really want to take a hard look at that, because as Dave mentioned before, taxes is a huge piece of this business. So we want to make sure that we're looking at any ways to save in that place, particularly with any sales tax. Another area that we've seen our clients save some money and able to secure some more cash is through their vendor relationships. Now, the group buying is out there. It's not for buying product, but it certainly is available for any of office supplies or nutrients or any other non-plant touching situation. So we really encourage you to think about that, going back to your insurance company, seeing if there's anything you can do about deductibles or certain coverages, and really take a hard look at any of your vendor relationships to see if there's a way that you can save some cash in the short run and hopefully provide you some funds for growth. We really like to look too at your cost structure and your operations, and using data to look at that. So for example, when you're looking at your inventory, do I have the right quantities of inventory? Do I have the right timing of my inventory? What am I spending my money on? Do I have the right people? And also looking at, where am I putting things on my financial statement so that I can maximize 280E and get deductions through cost of goods sold, and just really, really looking hard at your structure, looking at your operations. And we've helped clients, we've seen clients be able to save some money that they can then put back into their growth strategy by taking a look at some of those areas. Another item is a cost segregation study. So again, the point here is to try to get as much into cost of goods sold as you can, since we're still beholden, we believe, to 280E. So that's taking a look at any of the equipment, additions, leasehold improvements, anything that you've done, making sure they're in the right category and have the right life. So if you can accelerate some depreciation, since bonus depreciation isn't allowed in this space, that can all help with your effective tax rates as well. So moving on a little bit in more detail about operations. We really believe that having impeccable books and records is a must. This is not only to help you with your growth, but this is to set you up, as Dave had mentioned before, with a successful exit. One of the things, and one of my specialties I mentioned earlier, is in transaction advisory and helping clients through both buy and sell strategies. One of the things that you don't want to have happen, particularly if on the sell side, is to have anything come as a surprise to the buyer. And if you show up with impeccable records, understanding your categories, understanding what's in each of your general ledger categories, making sure that everything's reconciled, those are really positive messages that you're sending to your buyer, that you've got things under control, you understand your business, you understand what it takes to maximize under 280E. The other piece that we look at from both an investor coming in to support your growth or to prep you for an exit is making sure your cash flow projections are realistic. Typically, we're looking at an aggressive, a medium, and a worst case. But they really have to be based on reality. Look at your competition. Who could be coming into the area? What are your risk factors? Really taking a hard look at your cash flow projections and how realistic are they. Another one that we see, and we can't stress enough, is file and pay your taxes. And I think that there's this strategy, for lack of a better word, that we've seen some clients use, where they are almost using the IRS as a funding source and delaying paying. And in particular, areas like payroll tax, as officers of the company, you are personally liable for that. This is not a good strategy. You want to make sure that your budget, your cash flow includes paying those taxes. And depending upon what type of entity you are, if you're a pass-through entity, for example, an LLC that maybe isn't paying income tax, you still will likely have some sort of requirement for distribution for your members to be able to pay their taxes. So you want to take a very hard look at what your operating agreements say and really understand that cash flow. We've seen clients get caught up in that in the past, and you don't want to get behind the 8 ball. So having really solid financial projections and cash flow projections in particular can really help in that area. Now, one of the things we say here is run lean. And this is one where it really depends on the client what that means. Some like to have a very no frills operation. Some feel like the marketing glitz is really worth it for them and that they'll spend extra money on the marketing and the displays. You really need to understand what it is that's going to sell in your location. And having a good location, as always, particularly retail, is very key. So just take a hard look at your business. A lot of people ask us what are benchmarks, what are people spending on their marketing budget, as an example. And we really go back and stress, what is your strategy? Are you trying to differentiate? Are you using particular brands? Do you want to have your experience in your dispensary be some sort of experience that's different than another? And we have clients that are on the same block, 3 clients that are, within walking distance of each other. And they've sort of all come to the market with something a little bit different. So it gives buyers in that area some options. And maybe you're not competing as much as you would if you were exactly the same, having the same presentation. So really think very strategically about your location, particularly if you're a dispensary, and where you want to be no frills and where you feel like the cash flow is really worth the investment. So one of the other things that we've seen our clients utilize as a way to get cash in the door, and this isn't available to everyone, but it's a sale leaseback transaction. This is available if you have some sort of real estate, if you own the building that you're in, or if you have the property that you're building on, whatever kind of real estate that you might have, you can sell this facility to these entities that are out there that specialize in this. And there's some that just specialize in doing this for cannabis companies or have a specialty in it, where you're selling back that facility and they are leasing it back to you for your purpose. And, it can be for very favorable terms from a leasing perspective. So it gives you the ability to stay in that space, but also have some cash flow. So, you really, that can help you, because then too, you can allocate some of that rent, obviously, to cost of goods sold, or depending upon what you're doing in there. So that gives you some flexibility with regards to what you can and can't put through as something that could be deductible on your tax return. All right, so the last piece that I really want to spend a few minutes on is intellectual property. And on the next slide, we'll talk a little bit about what that means. So this is something that we have worked very closely with our clients on, and that's creating some sort of intellectual property. Could it be some sort of process that you have in your, and some of this is protected, some of it isn't, but we're going to throw it all into the one category of IP, and you can speak to a lawyer, an IP lawyer, about what's protected and what isn't, but about process, about something that you're doing differently. Can you license that? Do you have a certain brand that you can license? This also sets you up for being able to do work in multi-states. There are some brands out there that are known state to state. And because you can't bring product over the line, what you can do is license your process, license your packaging, license something that's going to help you with branding. And that can also be a source of revenue for you. And one of the things that we caution with this, though, is looking at those agreements. Make sure you have a cannabis-friendly accountant, of course, but also lawyer that's looking at that, because we've seen some agreements that aren't technically legal. For example, you could be branding something or licensing something to someone where they are taking possession of the cannabis in order for them to do whatever is needed on there, and they don't have the right license for it. So you need to make sure that you're thinking through the pros and cons of this. But we've really seen this as a great opportunity for you to have some growth. And then that also leads to a good exit. So you're going to be more valuable if you can show that you, particularly if we're going to look at rescheduling or descheduling or some point in the future, it really opens you up to being able to do more multi-state type of work. This is a way to do it legally now through your branding and through your IP. All right, so with that, I think we'll move on to the next polling question. And this one is about innovation and efficiency. And what's your approach?
So Janice, you stole some of my thunder there. I was going to talk about during the polling was that, if once we see 280E go away, which someday, hopefully, maybe next year with rescheduling, that IP can become very important from a tax point of view in terms of trying to move income out of a C Corp in a tax efficient way, as well as getting income out to your investors. We're gonna be talking about that, I hope, a lot next year as we begin to start working with clients once 280E goes away. So I'm going to be talking about some of the different exit considerations. We've been talking about growth, and that's very important, but all of it leads to the exit, because that's where we've all expected to get that bang for our buck, get the return on our investment is through a transaction in which we sell our business. And so when we're talking about exit considerations, The first thing is really choice of entity. And then, how is that transaction going to look, whether it's an asset or a stock sale? And then, what are some of the other options that might be available for that exit? Could it be an ESOP, or could we be trying to take advantage of qualified small business stock? And I'm going to talk about all of those. So when we're talking about choice of entity, when we first started working with you, and started to develop a strategy for your business, one of the first things we asked you was, what was your exit strategy? How long do you expect to be in the business? Who were you going to sell to? And that played a big role in terms of choosing the type of entity that you were set up in. Were you a partnership taxed on a flow-through basis? Were you a corporation as a C Corp? Paying its own tax? What were your investors expecting for a return? Were they expecting to get paid immediately for the use of their money, or were they waiting to get paid at the exit? Were you going to be reinvesting your profits in the business, or were you going to be distributing those out to your investors? And so again, when we're talking about making distributions to investors, we're talking about a partnership. Because one of the downsides to a corporation is that double level of taxation, meaning the corporation itself pays tax at that 21% level, but then to the extent that it distributes dividends out to the shareholders, they pay tax again. So if your investors were expecting from the very beginning some sort of return on their capital, a distribution to them, then we might have been talking about a partnership, which has a single level of tax. Now, one of the problems with that partnership is, all of your investors are getting that K-1 on an annual basis, saying they have to report their share of the income from the business and pay tax on that. And so they're paying tax on behalf of your business. And so what that goes along with is an expectation on their part that you're going to give them money to pay those taxes. Which we've seen from a number of clients over the year was not always the easiest prospect to think about, having to take 40% of your cash flow and distribute those out to your owners for them to pay tax. And that's when we started again looking more as corporations as a significant viable solution, because again, the only time that your owners pay tax is when you're actually distributing money to them in the form of a dividend. And when we're talking about 280E, again, well, that's not going to go away for a while, probably, or at least hopefully sometime this year. But when we're talking about 280E and we've got income coming in that is then being used to pay expenses that we're not going to be able to deduct, let's deduct those expenses. Let's pay tax on those expenses at a 21% rate inside the corporation, rather than at a 37% rate on our investors' personal tax returns. Especially where if I'm paying money out in a salary, I'm never going to be able to dividend that out to my shareholders, and so therefore there's no double taxation on that. Corporations also are a lot more friendly in terms of raising equity and attracting investors. Again, because those professional investors, they don't want that K-1. They don't want to have to worry about paying the tax on your behalf. And finally, the corporations have a significant advantage in terms of what's called the qualified small business stock. And I'm going to get to that in just a little while. But the choice of entity went a long way originally in setting you up, and that was oftentimes geared towards what kind of exit we were envisioning. And that really went to, what kind of deal it was going to be. And we've seen a lot of different deals inside the cannabis industry, and our clients have taken a lot of different vehicles and ways of exiting. And they take many shapes and forms, but ultimately it really comes down to two, either an asset sale or a stock sale. And so when you're thinking about it, an asset sale is when you're selling the assets of the business. You're not selling the business itself. And the nature of your business may really play a role in that. For example, in California, you can't transfer a license. And so therefore, you wouldn't be able to use that asset sale in California. You'd have to structure it as a stock sale where I'm selling the business and the license happens to go along with it. But one of the downsides of that stock deal is that when I'm buying someone's business, the liabilities go along with it. And so as we say here, that you'll inherit the sins of the previous owners. And so, that's one of the reasons why Dave and Janice both stressed, making sure that you're paying your taxes. Because if I'm going to buy your business and you want me to buy it as a stock sale, I need to know that I'm not, taking on those tax liabilities that may already be out there. And that, when you're thinking about structuring a deal for someone to buy you, you want to put that best foot forward. And in order to do that, you need to maintain good standing with the various tax agencies, with the CCC, all of those kinds of things. And that goes hand in hand, again, with having good books and records. So typically, the buyers, they want an asset sale. And the reason for that is if I'm buying the assets of an entity, then my cash is going into buying the equipment and the inventory and the like. And so therefore, I'm receiving a step up in basis in those for what I'm paying for them, which I can then turn around and depreciate. Now, that might not be as helpful on the dispensary level, because you generally can't take any depreciation on the dispensary level due to 280E. But on the cultivation side, it can be very important. In addition, they like the asset sale because they're not buying your liabilities. Those liabilities stay with you. You're still responsible for any taxes that might not be paid, as well as any potential lawsuits. So if you're looking to buy and you're trying to structure it as an asset sale, be prepared that the buyer is going to ask for more money, because on a stock sale, they have a much better tax advantage. And depending on structure, if you're a C corporation and you're buying in an asset sale, the seller is going to pay tax inside the corporation at 21% on that asset sale. And then again, now they're terminating their corporation to get the money out to their investors, and they're paying tax again. So asset sales are not so beneficial for the sellers. And so therefore, when you're negotiating, be prepared that the seller is probably going to be asking for more money. Whereas on the stock sale, where I'm just buying the entity itself, the business, sellers obviously prefer this because they're taxed at only one time, capital gain on the sale of the stock in the business. They also might be able to take advantage of the qualified small business stock exemption, which is an exemption on the sale of that stock, which can eliminate up to $10 million of gain on the sale of the stock per shareholder. I'm going to go into more detail of that in a few minutes. But there's also, on a stock sale, you might be able to take advantage of what's called a stock for stock deal. And we saw that a lot early on with those Canadian publicly traded companies coming down to the US and purchasing cannabis businesses and saying, I'm going to give you stock in my Canadian company in exchange for stock in your US company. And so the benefit of that is it defers the tax. That if I'm exchanging stock, I don't have to pay tax until I sell the stock that I'm transferring. Now, a lot of our clients might have seen an issue where that the stock that they traded for then, didn't necessarily value, and that's a risk that goes along with it. But from a tax point of view, it's very beneficial. And again, the buyers aren't necessarily as thrilled with a stock transaction because they're acquiring the potential risk, as well as they're not getting a step up in basis in those depreciable assets. So when we're talking about exit, again, we're going to be talking about stock sales versus asset sales. One of the opportunities, or one of the exit strategies that we're just now seeing, and honestly, we AAF has actually been talking about it for about 8 years now as a potential strategy. It was just finally getting the lawyers and ESOP administrators to agree with us on this technique. But this exit strategy is very interesting. It's the idea is I can sell my business to my employees in exchange for a note. And so I exit, I get paid over time from the business. The real benefit is that an ESOP doesn't pay tax. So if I sell my business to an ESOP and convert that business to an S Corp, there's no the ESOP doesn't pay any tax. Now, the business is still filing a tax return. It still files that 1120S as an S Corp, and it still employs 280E and shows a lot of income being reportable on the K1 that S Corp is going to issue. But if the ESOP is the sole owner, the K1 gets issued to the ESOP, and the ESOP says, thank you very much, takes that K1, puts it in the filing cabinet, and doesn't have to file a tax return and pays no tax on that income. And so that eliminates 280E as an issue because 280E just says, I can't deduct my expenses and I can't take credits. It says nothing about whether or not the owner of the business has to file a tax return and pay taxes. It can also, and so if 280E goes away, it's still a benefit because now, right now you're paying 60% due to 280E. If 280E goes away, you're still going to have to pay 30% at least. And so, all income taxes go away as a result of a sale to an ESOP. It can also be, if structured correctly, if I'm selling my shares to the ESOP, I may be able to not pay tax on that sale through a rollover of the gain into U.S. assets. If I sell my interest in my cannabis company for $10 million and I roll that gain into U.S. stock, Apple, IBM, whatever, I don't have to pay tax until I sell those shares down the road. So it's a tax deferral. Finally, we can structure the ESOP deal where your investors may be able to get a second bite at the apple, such that if the ESOP is sold or the business is later sold by the ESOP, those investors can step back in and reacquire up to 49% of the company, and therefore have an opportunity to participate in that second sale. So an ESOP is a really interesting structure that we're just now really getting to talk with our clients, and we've got a few that are moving forward with that. And so if you're interested, I would encourage you to reach out to your AAF advisor to learn more. I've alluded to qualified small business stock many times over the last several minutes as I've been talking. If you've been working with us from inception, you've heard me talk about it before as well. But the benefit of qualified small business stock, as I said, is an exemption on the sale of that stock up to $10 million per shareholder. And so if you've got 3 shareholders or 5 shareholders, that's $10 million a piece. So if you sell your business, you could very easily end up paying no gain, no tax on the sale of that business. And this isn't a deferral, this is a tax elimination. Now, I will say that qualified small business stock is very easy to mess up. It's very easy to lose this benefit. There are certain requirements that go into that. One of the things is it's small business. And so that means when you acquire your interest in the company cannot be worth more than $50 million at the time that you acquired your interest. Now, for most of our cannabis clients, that's not a problem, because they received their interest at startup when the company had very little value, and wasn't an issue. But going on, 80% of the corporation's assets must be used in the active conduct of a qualified trader business. And I'm going to get into what is defined as a qualified trader business, because that can be very important to a cannabis company. And they must have met this 80% test for substantially all of the shareholders' holding period. We've had clients who have come to us, not necessarily on the cannabis side, but they've been operating for 4 or 5 years as an S Corp. And they say, we're thinking about selling our business in the near future. What can we do to eliminate the gain on that sale? And one of the things that might come up is the conversion to a C Corp. Because again, it's only C Corps, not S Corps, that are eligible for this qualified small business stock sale. Well, the problem is, if they've been operating for 5 years as an S Corp, and now they're going to have to meet the holding period for qualified small business stock, which is 5 years, then they weren't operating as that qualified trader business for the full 10 years, only for the time that they were a C Corp. So therefore, they may not qualify, even if they hit that 5-year holding period. So, like I said, in order to qualify for QSBS, it's got to be issued by a C Corp, and it's got to be issued by the C Corp. You can't, if I buy my shares from one of the original shareholders, the original shareholder on the sale of those shares to me is going to claim QSBS and not pay tax on that sale. Now, I own the shares. I can't claim QSBS. It's not from shareholder to shareholder. It's from company to shareholder that you have to acquire it. As I said, S corporations do not qualify. You have to be a C Corp. And finally, you have to have held that stock for more than 5 years. So I had a client who sold their stock at 4 years and 11 months, not realizing that they were eligible for QSBS. Wait that extra month, sell it then, and avoid that $10 million in tax. The good news for that particular client is they had structured it as an asset sale. And so therefore they were paying the tax at 21% inside the C Corp. So then we were able to wait that extra month and have it qualify for QSBS and redeem the shares, so they weren't paying that second level of tax inside the dissolution of the C Corp. So we're always thinking on your behalf and coming up with different ways to help you and make sure we maximize your benefit. So that was one of the things that you can keep in mind. Moving on. So in terms of what qualifies as a qualified trader business, it's easier to find it as what is not a qualified trader business. And, unfortunately for us, an accountant does not qualify. Lawyers do not qualify. Anything that relies on the reputation or skill of the business does not qualify. Banking, insurance, financing, real estate businesses do not qualify. And for the cannabis industry, farming businesses do not qualify. And so if you're a cultivator and you're growing your product, there's a very real question whether or not that is going to qualify as a qualified trader business. Now, we think we might be able to argue that cannabis is not necessarily farming, but more manufacturing. There is, interestingly enough, a IRS audit procedure manual that talks about wineries and treats them as a manufacturer rather than a farmer. And so, perhaps we can make that argument on your behalf, but ultimately, probably better not to have to worry about that, and better to have, when you're thinking about the structure, back when we were forming your company in the first place, segregate the cannabis out in a separate a separate entity, and have your dispensaries in their own entity. In fact, here in Massachusetts, we can have 3. Let's have 3 different C corps, so that we have 3 different entities for each one of those dispensaries, so that you can sell any one of those dispensaries and take advantage of that $10 million exemption. Or if you sell all 3, take advantage of a $30 million exemption. But, let's say you are vertically integrated, and you do have your cultivation and dispensaries all in that same C corp. You should talk to us about what we can do to try and roll those cultivations out into a separate entity, or maybe enter into a sale leaseback to get rid of some of those cultivation assets, because you need to have less great 80% of your assets have to be used in a qualified trade or business. So if you've got 30% of your assets being used in cultivation, that could be difficult. Finally, tax-free exchanges. I spoke about this a little bit when we were talking about C corps earlier, and that's again, you have the opportunity to enter into what's called a 368 transaction, where I give you stock in my company, you give me stock in your company, and I don't pay any tax on that transfer. I only pay tax at such time as I sell the stock in the company that I've acquired from you. Like I said, it was very common earlier on with those Canadian publicly traded companies. We're not seeing that as much these days, but if rescheduling takes place and we see big pharma or big tobacco coming into the market, this could come right back into vogue. You just have to be careful of the value of the stock you're acquiring, and being aware that that could shift. I want to leave you with a favorite quote of mine from Wayne Gretzky, and that is the key to winning is skating to where the puck is going to be. You've got to think about the future and what's going to happen within our industry, and we encourage you to reach out to your AAF advisor, because we're prepared to talk to you today about what happens if rescheduling takes place, and what kind of planning we can do to put you in the best tax position. If 280E goes away, you're still going to be paying income tax, just not as much, but let's talk about what we can do to reduce it even further. With that, we'll go on to our final poll. And that's, again, going back to good books and records. If a buyer is going to put you under the microscope, how confident are you in meeting the due diligence? And if you're not, reach out to Janice. She's gonna fix you right up. I'm not sure what happened there. So that's the poll. And with that, I'm going to hand it back over to Dave to wrap it up.
Thanks, Josh. So just a couple comments. The last polling question, can't emphasize enough having good books and records. If you are under the microscope and due diligence, the better records that you have, the more valuable your company is going to be. Trust us on that. We've seen situations where our clients are looking to acquire other companies, and we go in and we see a bunch of issues, namely around 280E, and the tax exposure that that particular company has. So if you have good books and records and are in compliance, you're going to sell your business for more money, and that's the key thing. The other item that I wanted to touch on real quick was Josh had talked about, the tax-free exchange under 368. And if you do have a company that's looking to acquire your company with a stock exchange, offering their stock in exchange for your stock, just keep in mind that that needs to be the stock of a C corporation. You cannot do that with your LLC interest. That is a sale of an asset. The partnership interest, unfortunately, is an asset, so it turns into an asset sale. So that is where it's really key to get your business advisor involved in the transaction. That's where we spend a lot of our time consulting with our clients when they are approached for acquisition, is to make sure that the deal that's set on the table puts yourself into the best tax advantage, and that you can maximize the proceeds from the sale of the business. And if you have any questions, please feel free to reach out to any of your AAF business advisors or the partner that you work with. And we hope that everybody has a happy and safe Thanksgiving. And thank you very much for attending.